So, look, I'm introducing Peter Folds, and this is part of our monthly webinar series. Peter's from Washington Brown, and he's going to be assisting us with this month's webinar to provide an update on the budget changes regarding depreciation claims on investment properties. For those that don't know, Washington Brown do produce depreciation schedules and are leaders in the market in this area. So I think you probably would understand that the changes have dramatically changed the property investment equation in relation to depreciation on second-hand properties for purchases after budget night. But the legislation's only draft at the moment. It's just been released. So we wanted to provide an update for you on the second-hand properties. So Peter is the Alliances and Development Manager at Washington Brown, and Peter started with Washington Brown in 2007. And working alongside the executive sales and senior quantity surveying teams, he's responsible for the company's partnership program and business development. Today he will cover specifically what has changed, which property investments no longer allow for a depreciation claim, and which properties are exempt. So Peter, welcome to our webinar, the WSC Group webinar series, and we really appreciate your time, and I will hand it over to you from here. Thanks, Peter.
Thank you very much. Thanks, David, and thanks to the WSC Group for having me here, and of course to everyone online. Thanks for donating some of your lunch break to spend with me. I'll keep things succinct. As David mentioned, this hasn't been written into legislation yet, but our sources are telling us that things won't change too much from what's been proposed. On Friday the 14th of July, the Treasury Office issued a draft bill outlining significant changes to the way that property tax depreciation will be calculated and claimed moving forward. And so, as you know, I'd like to spend the next 15 minutes talking about them, going through the changes, and letting you know how they might affect you and future investment purchasing decisions from a depreciation perspective. So I won't spend too long on the next two slides because David covered a bit about who we are. So we're quantity surveyors. We've been around for over 38 years, and we specialise in tax depreciation. Essentially, as quantity surveyors, what we're doing is working out what things cost to build. So these are some of the clients that we work with, where we're fortunate to enjoy a good reputation in the industry and to work with some of the property industry's biggest firms, and also very proud to be trusted by WSC Group to look after the depreciation requirements for their clients too, of course. I always like to ask for a bit of audience participation. It's helpful for me to get to know the audience a bit. Sarah, I was wondering if you could help me with put up one of the poll questions. Just keen to know how many attendees own an investment property. Might give you a few seconds to fill that out. All right, thanks very much. Out of those people that do own an investment property, can you tell me if you've had a depreciation report done? How many who own an investment property have already had a depreciation schedule done? Because that's a big part of my role, and our role at Washington Brown is education. We find that not enough people know that they're entitled to claim. Thanks very much for that, Sarah. Okay, so just to kick off quickly, what is property depreciation? It's essentially the wear and tear on that investment property. So as long as the asset is income generating, just like a plumber would claim depreciation on his vehicle if he's using that to go to jobs, the government will let us claim the wear and tear as a depreciation deduction. Unlike valuers that are looking at what the market will pay, factoring in supply and demand, as quantity surveys, we're looking at the actual costs. So it's based on the construction cost. As I mentioned, many people don't know that they're entitled to claim depreciation, could be missing out on tens of thousands of dollars in depreciation deductions. What that figure is, we produce a report for the client that might say, $15,000 for this financial year as a depreciation deduction, and you use that figure to reduce your taxable income by that amount. So that's just a bit of an overview on what depreciation is. Let's jump into those changes. So the federal budget has changed the game for property investors in terms of depreciation. I know that sounds big and dramatic. On Tuesday, May 9, in the federal budget announcement, the government said they've been making substantial restrictions to the way depreciation is claimed. They didn't clearly define what that was, so we kind of spent 2 months in limbo. And if you were working in the industry as I am, we didn't sleep for those 2 months. It wasn't until the 14th of July that we received some clarity. Just before we jump into that as well, I've got one last poll question for you. Before the advertising for today's web event, just curious to know how many of you were aware that these big changes were happening to the depreciation legislation. Just leave that up for a few more seconds. Thank you. All right, thanks very much. That's interesting to see. All right, so in the good old days, you'd engage a quantity surveyor, an accredited quantity surveyor, such as Washington Brown, funnily enough, for this example. And what we do is we go to the investment property and we'd be assessing the plant and equipment component and the building allowance component. That's the two pieces that make up your depreciation claim. So the plant and equipment are things like the light fittings, the carpet, the ovens, and the building allowance is the building or the structure itself. Okay, so these are the two pieces of that puzzle. Even if the property was 10 years old, whatever you've paid for that property, a portion of that was for that oven, even though that oven might be 10 years old, even though the carpet might be 10 years old, you have paid something for those individual items. On an $800,000 townhouse in Sydney, built in 2007, if you purchased that in February this year, you might be looking at a $12,000 tax deduction in the first year. The plant and equipment component might be $8,000 of that, and the building allowance perhaps around $4,000. Okay, so this was in the good old days. Now what's changed? Basically, the government are now going to limit plant and equipment depreciation deductions to outlays actually incurred by the investor. They're going to deny income tax deductions for the decline in value of previously used depreciating assets. Okay, so that's their wording. Why have they done this? What are they reacting to? It's an integrity measure. So they're addressing concerns that some plant and equipment items are being depreciated by successive investors in excess of their actual value. And to put that into real terms, or to give an example, some operators in our industry were exploiting a loophole and revaluing second-hand equipment in an existing property at ridiculous amounts. To go back to my $800,000 townhouse thing, that's 10 years old. So you pay $800K for a 10-year-old property, and what was happening was some quantity surveyors were saying, well, there's a 10-year-old oven in there, but because you paid $800K, that oven, we're going to value that at $3,000, and we're going to start depreciating it over its effective life from $3,000. Now that's crazy, because that oven, it's now 10 years old. When it was brand new, it was probably only worth $1,000. So we agree that the government had to do something to address this. We feel they might have been a bit too extreme, but that's what they were reacting to and why these changes have come about. What it means is, as a result of these changes, unless you have actually purchased the item yourself, or the item is not previously used, as you saw from the government's terminology there, you will no longer be able to claim depreciation deductions on the plant and equipment item. Okay, and this is huge. As I said from that example with the townhouse again, of that $12,000 figure that you would have been able to claim prior to these changes, you're now not entitled to claim $8,000 of 12 things. So it's a huge difference, and you can imagine what missing out or losing the ability to deduct $8,000 would do for most people's tax equation. So for a house, that means things like the ovens, the dishwashers, the lights, the air conditioning, the television set, the carpet, and the blinds. These were all sort of larger ticket stuff. This is where a lot of the depreciation deductions used to be for clients purchasing an existing property, investment property. You can now no longer claim depreciation on any of these if they were previously used. Okay, if it was an apartment or a unit, in addition to that previous slide and those items, you know, we used to be able to look at and assess common property if your apartment, you know, was in a complex or a block. So things like lifts, smoke detectors, any carpeted areas, garage doors, the motors, gym equipment. You, as an owner in that, you used to be able to claim a portion of a depreciation on a portion of those items. And once again, with these changes, you're now no longer going to be able to do that. I fancy myself as a bit of an optimist, and when you take a hit like this to the industry you work in, you really want to try and extract the good news, and I must admit it was hard to find with this, but yeah, pretty positive person. So here's the good side, or the best we can make out of it. If you purchase a new property, a new apartment, for example, or you build a house, if that property is new, you will still be able to claim on depreciation on the plant and equipment items and the building allowance as per before these proposed changes by the government. So new property is exempt. Once again, it comes down to the government's wording that as long as the items are not previously used, you're still able to claim depreciation on it. So new property is exempt. Also exempt are offices, so commercial, retail, and industrial premises are not affected by these changes. So they continue to claim depreciation as they have been doing. So once again, if you go on to purchase any commercial, retail, or industrial premises, you're still entitled to claim depreciation on the plant and equipment and the building allowance component too. Even if that was a 15-year-old property, you're still entitled to claim on all of that. All right, so more good news is that there's been no change to the way that property investors are able to claim depreciation on the building allowance component. Remember earlier I mentioned that there are two parts to depreciation. It's the plant and equipment and the building itself. Provided the property was built after 1987, a property investor is still entitled to claim depreciation on that structure. Okay, and the way we work that out is it's 2.5% of the construction cost, whatever the quantity surveyor identifies or estimates that construction cost to be, and you're allowed to claim for up to 40 years from when the property was built. So to give you a working example, if you purchase a property today after these changes that have been proposed to depreciation by the government, if you purchase that property today and it's 10 years old already, even though you can no longer claim on the plant and equipment component, you would still have 30 years left of claiming depreciation on the building component, the capital work side of it. So yes, it's less than what it was pre-budget, but it's still much better in your pocket than the tax officers, and certainly you know, it all adds up. All right, so forgive my corny slide here, but you know, we're trying to make the best of the bad news. Remember, so it is grandfathered, these changes. So if you purchased your property, your investment property, prior to 7:30 p.m. on Tuesday, May 9, you're not affected by these changes. So anything that you exchange contract on prior to 7:30 p.m. on Tuesday, May 9, you are not affected by this. Even if settlement happened after, it comes down to contract exchange date. So hopefully a few people out there are breathing a sigh of relief. Okay, just some more good news. If the property was purchased under the following entities, you're also exempt from these changes. So that's under a company name, under a super fund, but I should mention not a self-managed super fund. This would be the big funds like a Hester, for example. They won't be affected by this. And also a large trust. The large trust, that's 300 plus members, is the purchasing entity or the ownership entity of that investment property. They're exempt from these changes too. All right, so if we have a look at this slide here, and I'll leave that up for a minute so we can all wrap our heads around it. What I've tried to do here with this slide is just to give you a feel of the cash flow equation for owning an investment property, given these new changes and what you can and can't claim in depreciation, and just comparing now, the different property ages. So you can see in the first column that about halfway down, you'll see the depreciation allowance is still the full amount. It's the plant equipment component, which is $15,000 as a tax deduction in depreciation. Because it's a brand new property, we can still claim on both of those. So that's why that's so big. If we jump across to the middle column, you can see the property was built after 87, but it's not brand new. Therefore, we can't claim the plant and equipment component of depreciation. We're only claiming on the building allowance, and that's why that depreciation figure there is 4,000. Now, if we jump across to the third column there, you can see that this is a property purchased, after the budget, but built before 1987. So built before 1987 means not entitled to claim on the building allowance component, and as it's bought post-budget, you're not entitled to claim on the plant equipment, which is why we see that unpleasant round number there for depreciation. There is no depreciation deductions available for that type of property now. Okay, so moving on, it's another statement to do with these proposed changes from the government. Acquisitions of existing plant and equipment items will be reflected in the cost base for capital gains tax purposes for subsequent investors. I must admit, as per my picture there, we're still, because as David mentioned earlier, this is not written into legislation yet. There's still a fair bit of grey area with this, so we are scratching our heads somewhat. What I can tell you about this is that if you buy a second-hand property, you can no longer claim the plant and equipment depreciation, as you've heard me speak. As an example, if there's $40,000 worth of depreciable assets, if you purchase a property now, second-hand property, even though you can't claim on that plant and equipment items anymore, if you sell that property in 3 years' time, the value of that plant and equipment items may have decreased to $20,000 when you sell it. This amount, this $20,000, can essentially now be deducted from the sales price when you're calculating your capital gains tax equation. So even though you can't claim depreciation on that $20,000 worth of plant and equipment items anymore, you'll still need to know their value at the time of the purchase and at the time of to be able to know their value at the time of selling, if and when you do sell that investment property, so that can reduce the amount of capital gains tax you pay. And that is that's better than good news from my perspective and Washington Brown's perspective. It's great news. And why? It's because you'll still need a quantity surveyor to be able to calculate those values. Now, that pretty much covers it. That's an overview of these changes. As I mentioned, they're not in legislation just yet, but we have it on good authority that things won't change too much from what's been proposed. I hope I haven't gone through that too quickly and that's been informative for you. And I'd welcome any questions that you may have now.